Thanks for watching this video on Accounts Class 11th. If you want to purchase the entire course, you can click the link in the description, or if you're watching this on mobile, you can click this downward arrow link and you will get the link to purchase the entire course.
Okay, so now I'm going to tell you what are the entries, journal entries made for purchases and purchase return. Purchased goods worth rupees 10,000 on cash stroke bank, credit from James to returned goods worth rupees 500 to James. So when you purchase goods, what are the two accounts which are involved? One is obviously your purchase account, and second is either your cash or bank account or the creditor's account. Okay, so when you purchase is what? Purchase is an expense and an increase in an expense. When you purchase, you are incurring an expense, you are increasing your expense, and as per the rules for debit and credit that we saw, an increase in the expense is debited. So I debit purchase account. Debit how much? 10,000. 2. Now there are two situations here. One is you make the payment from cash or bank account, right? So when you make a payment through a cash or through a bank account, both of them are your assets. And once you've made the payment, the balance obviously goes down, right? Which means it's nothing but a decrease in asset. And what do we do to decrease in asset? That is credited. So you credit cash or bank account by 10,000. This is insofar as your situation 1 is concerned. The narration being purchase is made through payment from cash or bank as the case may be. Credit from James. Again, in this case, the purchases account would be debited as was done in the first option. 2. But instead of cash or bank, we got the money from purchases from James. But now what has happened is we need to pay James this money. And James is what? James is now my liability. And if you remember, if you have a liability, an increase in liability is credited, right? Accordingly, I credit James by 10,000. So this is for the entry number 1. Now many times what happens is once you've purchased the goods, after some point in time you may realize that there are some damaged goods, or there are some goods that you don't require and which you can return to the seller. So you return goods worth rupees 500 to James. Now James is what? James is a liability. Okay. And when I return this goods to James, I owed him 10,000, but now I will owe him 500 rupees less. So there is a reduction in my liability. And a reduction or a decrease in the liability is what? It is debited. So I debit James, debit by 500. And what would I credit? Return goods. When I bought these goods, where did I debit them? I debit them to the purchase account. So there are two methods which I can follow here. I can say I want to credit the purchase account by 500, or better still, the way it is done in accounting is you open a separate account called purchase return account and you credit it by 500. At the end of the year, this purchase return account, which is standing here, is reduced from the total of purchase account. And in the narration, you will put in that being goods purchased from James returned. And that's the end of the matter.
Thanks for watching this video on Accounts Class 11th. If you want to purchase the entire course, you can click the link in the description, or if you're watching this on mobile, you can click this downward arrow link and you will get the link to purchase the entire course.